In my last video, we discussed the difference between subject to and seller finance when it comes to creative real estate investing. Both are powerful tools, but I'm sure you're still wondering, why would a seller actually sell or use one of these strategies to begin with? To keep things simple, I'm just going to split each of these strategies and why a seller would use one of these into two separate videos, just to kind of keep things a little bit more simple and so that it's easy to come back to and reference. So in today's video, we're going to talk specifically around subject to and why a seller would choose this path to potentially sell their home. So what I'm going to do as we talk through this is I'm going to record on my iPad and draw out just a little bit more around why a seller would sell this route. So again, today we are talking about subject to and why a seller may sell this route. You know, a lot of times a seller may decide to go the subject to route for a few different reasons. A lot of times they may be in a tough spot, and a lot of times, you know, the benefits of selling subject to far outweigh any of the risk that may be involved. So one of the big ones when it comes to why a seller may sell subject to is simply because they might be going through foreclosure soon, and maybe they are in pre-foreclosure. So one thing to note about this, as we all know, is that when someone is going through foreclosure or they're about to, there's something happening in their life that maybe we are not aware of, and they are no longer able to make the original mortgage payments that they had in place. And what we also know about that is it can be very damaging to their credit. So with that being said, they need a quick solution, most likely, to make sure that they do not go into foreclosure, because the moment that they do, it will really impact their credit and may really affect whether or not they are ever able to purchase another home in the future. So what is great about having a seller, you know, want to sell subject to when they're going through a situation like this is they're opening up to a new pool of buyers that they weren't originally open to if they maybe were trying to sell it on the market. So an investor could come in, take over the mortgage payments that they had in place, get them caught back up on their loan depending on what that amount is, and continue to make payments on that mortgage. Now remember, in a subject to transaction, the mortgage stays in their name. So if you think about it, let's say you're about to go through foreclosure and obviously you are behind on your payments, it starts negatively impacting your credit, but an investor comes in and begins making payments on the mortgage, gets it caught back up, and continues to make payments on that mortgage while it stays in your name over the next few years. What's great about that is that your credit then starts going up again, and you're having someone make steady payments on the mortgage, which is positively impacting your credit. So that is one reason a seller may want to sell subject to, especially if they are about to go into foreclosure, is because it really honestly could help their credit if you bring in an investor that you know will continue to make those payments on time. And don't worry, there is a performance clause that is put into the contract at title to make sure that you are protected so that the investor himself doesn't eventually default on the loan, but it tells you what happens if that were ever to happen to make sure that you are protected. This is number one as to why a seller may sell subject to. So now let's talk about number two. The second reason a seller may sell subject to is because, let's say it's about to be expired. An expired listing, as you know, is a seller that was on the market and they were trying to sell it traditionally. However, they were having a hard time and didn't have any luck for some reason. So what that means is that listing then comes off the market and is no longer an active listing. Now, one of the reasons that you might see sellers go expired and they don't have any luck selling is because they have low equity. So let me just break this down into an example so you understand exactly what I mean by this. So let's say a seller, we're selling their house on the market traditionally. This is the house, and they were asking $200,000. However, the issue here, because they have low equity, they had a mortgage in place of $180,000. So what does that mean exactly? A regular person looking at this, when I ask, okay, how much equity does this seller have? A normal person who may not really think a lot about how transactions work in real estate, or who may just not have the experience around it, may say, well, they have $20,000 in equity, right? The answer to that is no. Because when a seller sells on the market traditionally, you have closing costs, and agent commissions. So with that being said, if this seller were to sell at $200,000 at their asking price, they would actually probably have to come to the closing table and write about a $5,000 or even a $10,000 check just to close. That's not 10, by the way. $10,000 check just to close on the home, which obviously can be a problem for some people. So just imagine a seller that then is not selling at that $200,000 and it sits on the market. They can't really drop their price anymore, because then think about it. Let's say they drop their price to $190 and it's still not selling, yet they owe $180. These closing costs just continue to climb, and that can obviously be a huge problem for a seller. So what happens, they just don't drop this price, it sits there just like that, and then it turns into an expired listing. So what happens then is a investor can come in, or a buyer, and then tell the seller, hey, I will actually purchase your home for $200K as long as you let me take over that original mortgage that you have in place of $180,000. And why would an investor want that? Because let's say this seller has a 4% interest rate. And if that investor were to go to a bank nowadays to get a loan, they are probably going to get like a 6 or 7% interest rate, which really hinders their ability to cash flow as much as they can. But if they take over this mortgage payment at the 4% rate, that helps their ability to cash flow. And because the investor is able to get in and get that low interest rate, guess what they are okay with doing? They are okay with paying the agent commissions, and they're okay with paying the closing costs. So this seller who was in a tight spot and was having a hard time selling their home on the market because they couldn't decrease their price is now able to sell it. They are no longer responsible for the mortgage payments. They are not having to come to the closing table and pay money out of their pocket. So that is the other reason why a seller may want to sell subject to. And the third reason a seller may want to sell is simply for a quick close. A lot of times you will see sellers who really honestly, they just need to close on their home quickly because there might be something happening in their life, whether it's relocation, maybe they're going through a divorce, maybe you just never know, again, what people are going through. But what we do know is that they need to sell it quickly. And if they put it on the market and try to sell it traditionally, a lot of the buyers that are coming to the table will need financing. And so what that means is that even by the time they get an accepted offer on the home, which may take a couple of weeks, they then have to wait for that buyer to go to a bank, qualify for traditional financing, which then means appraisals have to happen, the banks have to underwrite it. There's just a bunch of hoops to jump through, which really draws out that closing timeline. However, if a seller were to go and sell it subject to, where simply an investor's coming in and taking over those mortgage payments, they can close in under 30 days if they need to, because there's no hoops that need to be jumped through. You simply just have to work on setting it up with title. And this is a standard transaction with title. You know, they are used to working on these kind of transactions. They've had a ton of experience. Selling subject to has been around for years and years and years. So at the end of the day, these are really the top 3 reasons as to why a seller may sell subject to. And the main thing is that there's usually always pain involved. And that pain is why a seller is needing to sell, and unfortunately they're in a tight position. So I hope drawing all this out kind of helps you understand why a seller may sell subject to. And in one of my future videos, we will talk further about how a seller is actually protected in these scenarios, because you may be thinking, Ashton, this sounds great, but what happens if the buyer or the investor comes in and they fail to make the payments on the mortgage that I let them take over the payments on? Since it's still in my name, won't that affect my credit? Well, what happens is we put a clause in place called a performance clause, and it simply protects you that if they were ever to fail to make payments in the future, that deed automatically transfers back in your name, and you keep the original down payment they ever made way back when the transaction originally occurred. And you also get to keep all the payments they made to your mortgage along the way, and none of the closing costs or commissions come back out of your pocket or anything like that. It's really a benefit to you as a seller, especially if you're in a tight position, but we will dive in a lot further clear around how you are protected in this scenario. So I hope this video helped you guys out a lot, understand why a seller would sell subject to. If so, make sure you give it a thumbs up and drop any comments down below if you have questions. I'm sure there might be. I still have questions about this sometimes, but at the end of the day, the goal is that we are all learning together. And in my next video, we will talk a little bit further as to why a seller may sell on seller finance, which again means we are creating a mortgage with the seller. There's not a mortgage in place already in which we are taking over payments. Make sure you subscribe for future videos, and I will see you guys in the next one.